what's interesting is the forecasts came out as well. And I wanted to kind of go over that. I wrote that down here for 2022. They're kind of across the board. There's different, places that we really go to that we trust for the data. And the top four are CoreLogic, Goldman Sachs, Zillow, and Fannie Mae.
Hey y'all, Katie here with Team Evo AZ at eXp Realty. We are so excited for season 4 of R.E.A.L with Matt and Katie, and we have so much juicy real estate goodness lined up for you for this season. Thank you so much for following us and for listening to our show. Remember, we are based in the Phoenix, Arizona area, so if you're interested in buying a home, selling a home, or you just have general real estate questions, please don't hesitate to reach out to us. We are a valley-wide team. Our handle is at Team Evo AZ on all of your favorite social media platforms. Enjoy the show.
Hey everyone, it's Matt and Katie, and you might notice Matt is not with me. Whoops. So it's just Katie today, guys. And but typically Matt's here with me. We are the real estate couple talking a lot about real estate and a little bit about life, based in Phoenix, Arizona. For those of you who know, Matt and I have just purchased another home, so we're up to 5 now, guys. We're collecting them over here, right?
Awesome.
Yeah, it's our thing. And we are in the absolute thick of a remodel. We decided to do that during the holiday season. Yay, us. And there are, some delays due to holidays and due to other things going on in the world, right? Of materials and things like that. So poor Matt is over at the house, just busting and grinding. I mean, it's been honestly candle at both ends for that poor guy.
We're looking forward to seeing his handiwork, the before and after pictures, Katie.
Well, thank you. I will of course share. But outside of that, so that's this whole ball game that Matt and I have kind of gotten ourselves wrapped up in here. But outside of that, let's catch us up on rates. What's been going on, Ryan?
Yeah, so it's been a wild ride. I know we had discussed on our last call that, rates are really going to be having kind of upward pressure, for the foreseeable future. Mm-hmm. And the reason why, of course, is inflation is hot. It's high. It's at some of the highest levels we've seen in a while. And inflation is bad for interest rates. That's always going to drive up mortgage rates. And on top of that, since March of 2020, when COVID happened, the Fed has jumped in and kept rates down, and they're slowly taking their foot off the gas. So those two factors are really what's going to lead in the near future here to increase interest rates. But there's always those wild cards that come up that could kind of shift things. As they're increasing, we see temporary drops, which we're actually seeing a little bit right now. And the reason we're seeing that was the news of the Omicron variant. Hopefully, I'm pronouncing that right. I've heard a couple of people saying it different ways.
Yeah.
Omicron variant. But so when that hit a couple of weeks ago, that spooked the markets, and you probably saw the stock market was a little bit of a sell-off. And when the stock markets do drop, that usually favors interest rates because people move money into safer securities, which are bonds. And when they go into bonds, that lowers the interest rates of those bonds, which is, what mortgage rates are based off of. So the uncertainty of that variant hitting was good for interest rates. So even though we see pressure for interest rates to increase, we did see a temporary drop because of the new variant that came out. But as new news started coming out that, it's less severe, that the vaccines that are out there are protecting against it, we did see a little bit of a rally in the stock market, and rates are starting to kind of have that upward pressure again. So we did see a little temporary relief, but we're starting to see that upward trajectory start again.
So we had a quick dip.
We did. We did. It was very quick. It was like a 2-week dip, but we're starting to see the increasing again.
Gotcha. Was it long enough to see any effect in the applications that you've been taking, or have you been pretty steady Eddie on that?
It was, yes. Especially now that equity has risen for so many of our past clients that we've helped. A lot of them are tapping into that, especially during the holidays, when you want to free up some money to maybe pay off some credit cards, consolidate some debt. So we did have some clients take advantage of that through doing some cash out refinances. Yes.
Oh, interesting. Let's talk about that a little bit. What does that look like for somebody that might have been, maybe they got their place in 2018 or 16, 17, 18, something like that. So they're sitting on quite a lot of equity at this point, more than likely. What does that look like for somebody that's wanting to do, for instance, I was talking with one of our mutual clients, she'll probably be calling you, about doing a home improvement loan. Are we
Yeah.
seeing those come up?
Yeah. So, we're seeing a lot of different things come up. So the way it works is when you're doing what's called a cash out refinance, you could borrow up to 80% of what your home is worth. And so that does two things. One thing that drops your mortgage insurance if you're paying it, because as long as you have 20% equity, you don't have to pay mortgage insurance. But two, if you have enough equity based off of that 80% loan to value, when you pay off your current mortgage, you could keep the difference, and that's cash in hand that you could use to pay off, high interest credit cards, student loans, car payments, things like that, or even do home upgrades, which a lot of our clients are doing right now. So that's one option. But as rates are starting to increase, and if people have refinanced over the past few years into low rates, maybe in the high twos, and we're starting to see them in the low threes, some of them are taking out home equity lines of credits or second mortgages. So those have different guidelines. But sometimes you could go up to what's called a 90% combined loan to value. So 90% of whatever your home appraises for, you could take out a second mortgage or a line of credit. And those typically have higher interest rates. So not everybody really wants to go with them. And sometimes it could be variable, interest only. So with rates as low as they are now, we still have a lot of clients, deciding to go with a full cash out refinance because that's still going to be the best option.
Yeah, for sure. I've been seeing that also. And, getting rid of that MI payment for some people is a couple $100. I mean,
It could be significant depending on your purchase price. Yes. And if you put anywhere between 3 and 5% down, the mortgage insurance amounts are a lot higher with that little of a down payment. So we've had clients saving $300 a month. And so we've had some circumstances where we did a cash out refinance. Their interest rate was up a little bit and they were taking 30 to 40,000 cash out. But because we dropped the mortgage insurance, their payment remained the same. So it's pretty exciting for them to take that money out to pay off debt and not have their mortgage payment change.
Yeah, absolutely. And now are you seeing, and I know it's probably hard to tell what people do with their money all the time, but are you seeing people doing that, paying off debt or doing home improvements? Or are you seeing them going out and buying boats and jet skis like in 2005?
Yeah. So I've been around for a while. I've seen different cycles and different, markets that we've been in. And back in 2006, 7, and 8, that's really what we saw because we saw property values shoot up. And people were taking equity out of their homes, but they were, buying luxury items with them. It seems like that they've learned their lesson from that because we obviously saw what happened back then in 2008 and 9, and there was a pretty large correction in the market. Now we are seeing more debt consolidation because we do that through the refinance. We pay it off directly through the title company. We send the checks from the cash out refinance to pay off the cars, the student loans, and we settle that all for you. So we know when it's going to be going towards upgrades or for luxury items or when it's debt consolidation. And we're seeing a lot more debt consolidation this time around.
That's good. And that's something that you consult then, it sounds like, with your client and kind of help them to decide what should be paid, that kind of thing.
We do. Yes, we do. Yeah, we look at all the statements and try to determine what you're going to get the most bang for your buck. What has the highest interest rates, what's going to save you the most by paying it off. So that's something we definitely do during our consultation.
Let's talk about this. So I've run into a few financial advisors, very few, but a few, that have suggested to people to pay off all of their debt, meaning no trade lines. But that isn't necessarily the best route, depending on the situation. Can you speak to that a little bit?
Yeah. So paying off debt, of course, is great. The one thing that it does impact, which you're probably referring to, is maybe your credit scores.
Right.
Because sometimes when you pay everything off, it doesn't show any open and active credit. And that does have a negative impact if you go months and months without having any activity. So we don't always recommend it because we like to have you having open and active trade lines. So what we typically recommend, if you're paying off car loans, student loans, that's great. But always to have maybe 2 or 3 credit cards that you're using on a regular basis. One to maybe charge gas for, another one for groceries, but paying them off each month. So you're not getting hit with those interest payments, but you're still keeping your credit open and active, which will keep your credit scores high. So it's kind of the best of both worlds. And plus, there's some great credit cards out there that you could get, bonus points for. Myself, my wife, we use the Southwest credit card, and we pay it off each month. We don't pay interest on it, and we haven't paid for a flight over the past 3 years because we keep accruing points. So yeah, that's typically what we recommend, is always to have maybe 2 or 3 open credit cards that you're paying, but try to pay them off each month.
That's awesome. And so, for instance, let's just say you bump into somebody that wants to do a refinance and they have met up with one of those financial advisors that told them to pay off all their debt. Obviously, they're going to have their mortgage on there. You know what I mean? But if you don't have enough credit or enough trade lines, whatever, to do your thing, is there still alternative credit? Can you get the information in other ways?
Yeah, there are cases where you could add alternative credit. Like a lot of people have probably seen commercials for Experian Boost, and really, what Experian Boost does, it's a pretty cool process. They actually add maybe your utility bill, like SRP, or Town of Gilbert, your water bill, for instance, or they'll even add like your Verizon or T-Mobile bill. Those are alternative credit that they could add. And it increases your score. And that's funny because we work with a lot of clients maybe who have scores in the mid to high 500s that we're trying to get over like a 600 or a 640 to get a better interest rate and more programs. And they have used Experian Boost and added those alternative trade lines, and it has bumped up their score. So it's great that you ask about that.
Awesome. And there's no negative impact to that. It just acts as though they had a regular credit report.
It does. Yeah. It almost acts like it's an installment debt or even a credit card in certain circumstances. So if you've been paying it on time, it's a great way to boost up your score. And right now, unfortunately, it's only with Experian. So if for any reason, there's 3 credit bureaus, of course, there's TransUnion, Equifax, and Experian. And if for some reason Experian is a little bit lower, it's a great way to boost up that score. So maybe your middle score out of all 3 will be higher for qualification purposes. But what's great is we don't even account that against you, though, even though we could see it on your credit report. So we can maybe see, like a $150 SRP bill on there, or even like a T-Mobile bill. We actually don't count that towards your debt for qualifying. So we could exclude that as well. So it's kind of the best of both worlds. You get that pay history, but we don't count it against you for qualification purposes.
Nice. Yeah, that is kind of awesome. Glad I asked that question, Ryan.
Yeah, great one.
So as far as the inventory levels, as far as what's going on out there, it's kind of the same. I'm feeling it is still, we're still very, very low. We're at like, a month and change inventory out there. Probably just around 5,000, houses, single family, Pinal County and Maricopa County combined. That's usually all that I look at. So it's definitely bumped up a little bit since the summer. Are you still feeling like it's pretty busy even through the holiday season in terms of taking applications and things like that?
We have felt it's still continuing to be very busy. We're getting the same level of applications at this time. And it's interesting. The results just came out. I think people are kind of seeing how much homes are appreciating, and it's not really stopping, because Arizona again was number 1. Phoenix was 31% in the past 12 months, and that's ahead of San Diego and Las Vegas as well. I think Vegas was 24%, San Diego was 22%, and we were 31%.
Wow,
which is crazy. But what's interesting is the forecasts came out as well. And I wanted to kind of go over that. I wrote that down here for 2022. They're kind of across the board. There's different, places that we really go to that we trust for the data. And the top 4 are CoreLogic, Goldman Sachs, Zillow, and Fannie Mae.
Yep.
So this is how it goes. CoreLogic, they're kind of the most conservative. They think there's going to be a 2.5% increase. Goldman Sachs thinks there's going to be 16%. So they're pretty far. There's a big difference between the two.
Wow.
Zillow's thinking 14%, and Fannie Mae is thinking there's going to be 7.5% appreciation. So that averages, if you take all 4 of those organizations that are very well trusted, that's going to be a 7.5% increase. So I think a lot of our clients are still seeing that in the news, that there still are going to see those high levels of appreciation next year. It's going to be a strong housing market again. and they want to get in while the rates are low. I think that has a lot to do with it. The high appreciation, rates going up, they want to get in before affordability kind of, unfortunately, it's more difficult to qualify.
It really is. And that's kind of the other side of this conversation. And my question to you is, how many people are you turning away, Ryan, and telling them, hey, your DTI is just not where it needs to be, or you don't have the funds for the down payment that you need to have? How is that going?
Yeah, it's not so much turning people away at this time. We are getting them approved, but it's for home prices that just there's really not options out there.
Yeah,
it's hard. It's very hard. We're working with a lot of first-time home buyers. Some young millennials out of college who got their first jobs, and they qualify maybe for 200 to 250. And in Maricopa, I mean, you could attest to this, Kate. Like, there's not much out there at all in that price. You can't find anything.
Yeah, nothing.
Yeah. Which 5 years ago you could still find, something pretty good. So that's what we're running into. We're running into more and more clients who are qualified, but they're starting to feel that frustration of not finding anything in their price range out there. So the way that we're kind of working with that, we actually have them having co-signers where their parents are helping out. We of course try to qualify them for down payment assistance programs to help with the down payment if they don't have that saved. So we are, trying to find more creative ways to get them approved for a little bit more, to give them more options. So that's kind of what we've been working with over the past year or so.
I'm feeling kind of sorry for them, Ryan, for the first-time home buyers that are wanting to get into the market, and their competition out there is really stiff.
It is,
and there's a lot of Wall Street money in Phoenix right now. There has been for some time. And these are like big, giant investors. So I kind of hear chatter on social media and stuff. Oh, these investors that are snapping up property and they're renting them out, and they're gouging and all of this stuff. We have to understand that there are two different types of investors, right? There's the people like me, like I have 4 houses. I'm not gouging anybody. Okay. And then there are these other big, giant groups of investors that are the ones that are scooping up these properties before they even hit the market. And they're the ones that are really driving up the rental prices. I'm feeling the pinch for those first-time home buyers that are trying to get their foot in the door, and they're up against these huge groups.
I agree. And what's interesting is we're starting to see the kind of sprawl where people are going more on the outskirts, like they kind of did, during the 2006 and 8 boom that we had when those prices jumped up so much. So we are, we are having more luck with our clients finding homes in maybe Maricopa or Santan. So, more of the outskirt areas that might be a little bit more affordable. We're starting to see more people do that, especially now where a lot of people are working remotely and maybe living in Santan. Even if you have a job that's based out of Phoenix, it's not that big of a deal. So we have been people that are more open to going a little bit further outside of the Phoenix metro area.
Yeah, I mean, Maricopa's popping up. We got a bunch of buyers there right now. Casa Grande is actually getting pretty cool and has some really, still you can get into a property super reasonable there, even a brand new one. Florence is starting to make a little comeback. So I totally agree with you on that. And I think since 2020 and all COVID happened and everything, we're seeing more people that are able to work from home. They don't have to commute. So that works out a bunch for them. Another sort of funny thing that I've been seeing, I was talking to Matt about the other day that I thought was just kind of interesting. We may or may not have touched on it on a previous episode. So you remember prior to COVID hitting, everybody was doing like I want to be in the city and I want the tiniest property that I can get, right? And it was low maintenance, walkability, tininess. Then COVID hit and we had to be in our tiny houses for, I don't know, X amount of months straight. And I'm starting to see a different trend now where people are getting larger homes. They're moving further out, like you're talking about. Of course, we still have a bunch of activity in the city, but they are tending to move further out. They're looking for larger homes. They want the gym. They want the office. They want all the guest house, all that stuff right there in the home.
Well, definitely.
Yeah. So we're seeing a lot of that.
As well. Yeah, definitely. I agree with you, Katie. I'm definitely seeing that as well.
And then there's a big change coming though, that can kind of help out these home buyers that are having some struggles, maybe collecting down payment, and with the prices going higher and higher, they're having to reach higher and higher. So that down payment, when you look at percentages, that down payment just gets higher and higher, right? And so what's coming to the table in January that's going to help us out on the conforming end?
Yeah. So as we had just discussed, property values have been going up significantly, especially in Phoenix. Because of that, they have announced that they're increasing the conforming loan limits and FHA loan limits as well. So in the Phoenix metro area, what they've increased it to is to $647,600 is the new loan limit, which is crazy because between 2006 and 2016, it didn't change at all. It was at 417,000. So we've seen a big jump over the past 4 or 5 years. Yeah. So I always have to try to memorize it because it's been changing every year. I'm like, oh, what was that number again? So it's 647,600 is where we're at for conventional, and for FHA that is actually going up $85,000 up to $356,362 is where it's at. So the reason why that's a really good news for our clients is, as property values go up, you might have to go to those higher ranges, and you could qualify with a jumbo loan, but there's a lot of restrictions with jumbo loans, and they're harder to get approved for. You need maybe more of a down payment. The interest rates could be a little bit higher, and you might need to have extra reserves, more credit history. So they're harder to get qualified for, and they need a larger down payment, as I mentioned. So it opens up a lot more options for people trying to qualify for higher purchase prices, since that's very much needed as prices have gone up so much.
I was going to say it's indicative of what's been going on, right?
Yes.
And correct me if I'm wrong, but jumbos are higher. Obviously, they higher costs, so higher in interest rate, and they're harder to get approved for. Because they're not backed like conforming loans are backed.
That's correct. Yeah. Okay. Conforming loans and FHA loans, that they are backed. Like FHA is a government loan, so they have mortgage insurance. So they have a protection against defaults. Because of that, we could typically have better interest rates and lower down payments. But conventional jumbo loans don't really have that protection. So, and of course, the banks are being exposed a little bit more with higher loan amounts. There's more risk. So they are a little bit more sticklers, and with that risk, there's higher interest rates. And like you mentioned, there's lower debt to income requirements. So instead of maybe you could go up to 50 or even 56% for debt to income ratios for FHA and conventional. For conforming, sometimes you're limited to maybe 40%. So you're not able to qualify for as much with a jumbo loan. So it really opens up a lot more options, being able to go higher on these conforming and FHA limits.
So come January, you essentially can get a $600 some odd $1,000 house for 5% down. Is that
5% right? Down. That's correct. Yes.
Yeah. And you're going to have MI on that.
You would. Yes.
Yeah. So there's that. But hey, I feel like it gives a little bit of relief out there for those that are just looking for their primary residence, and that's what they're going for. You know what I mean?
Absolutely.
So awesome. Well, Ryan, I feel like our followers know who you are. So in the beginning of the show, I didn't even say this is the wonderful Ryan Gilliam with Waterstone Mortgage, who is here with us every month, giving us his insights and all of his juicy goodness in the mortgage world. So I really appreciate you being here.
Yeah, they know me by now, right?
I think that's why I was like, oh, hey, it's just normal. It's like we're having coffee here. All right, everybody. Well, thank you so much again for being with us today. If you are interested in being a guest on our show like Ryan, please follow us at Team EvoAZ on Facebook. That is our handle. We're also on YouTube, TikTok, and Instagram. And just send us a little message about why you think you would like to be a guest on our show. We are always looking for some awesome real estate professionals out there to talk with. And please, while you're there, if you could subscribe, download, and rate our podcast out there on your favorite podcast platform, that would really help us out a bunch and helps us get this real news out to the real people. All right, Ryan, it's been real.
Thanks, everyone. Thank you, Katie. Thanks, Matt in spirit. Missed you today.
You'll be watching the replay later, I'm sure.
There you go. Thanks, everyone.
Bye.
Bye.